The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm welcome to Squawkbox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. Well, getting their facts straight. Crude prices whipsaw as the White House says the US Navy has not escorted an oil tanker through the Strait of Hormuz, correcting a now deleted social media post by Energy Secretary Chris Wright.
The U.S. Navy has not escorted a tanker or a vessel at this time, though, of course, that's an option the president has said he will absolutely utilize if and when necessary at the appropriate time.
The International Energy Agency reportedly proposes the largest ever release of oil reserves as the Middle East conflict continues to choke global supplies.
Porsche just misses full-year sales expectations as the carmaker says it will look to make itself leaner. Meanwhile, rival Renault doubles down on its EV offerings, with the group CEO telling CNBC it is the future.
EV is good for customers. Renault customers moving to electric cars, they don't want to go backwards. The problem of EV is the price, the autonomy of the battery, not the technology by itself. So it's why we think that we have to continue to push, to target.
This is the point where I normally ignore the producers and the director and just leap into a conversation with Karen and Ben. But I don't want to do that. I want to just read the next read, and I want you, the viewer, to make your own mind up, okay? I'm going to make no assumptions. I'm going to say no words. I'm just going to read the words as they are printed on my auto cue, and I'm going to add nothing. And you make your own minds up. Crude continues to be highly volatile amid confusion surrounding the Strait of Hormuz. Prices fell sharply late Tuesday afternoon after the US Energy Secretary Chris Wright said in a social media post that the US Navy had successfully escorted a tanker through the critical choke point. The post was deleted shortly afterwards, with an Energy Department spokesperson later saying it was removed after it was, quote, determined to be incorrectly captioned by the Department of Energy staff. White House Press Secretary Caroline Leavitt was asked about the post about an hour after it went up and confirmed that no such escort had happened.
I was made aware of this post. I haven't had a chance to talk to the Energy Secretary about it directly. However, I know the post was taken down pretty quickly, and I can confirm that the U.S. Navy has not escorted a tanker or a vessel at this time, though, of course, that's an option the president has said he will absolutely utilize if and when necessary at the appropriate time.
In the meantime, US forces have sunk 16 mine-laying ships in the Strait of Hormuz overnight. Amid reports Iran was seeking to mine the critical waterway. It comes amid further mixed messaging from the White House over its actions in the region, with President Trump initially posting that Washington had no reports of Tehran laying mines, but urged the immediate removal if there are any, threatening military consequences. Less than an hour later, the US leader posted that, quote, within the last few hours, 10 inactive mine-laying vessels had been destroyed.
Laying mines, not laying mines, escorted tankers, not escorted tankers. This is all the White House talking. This is not us journalists adding commentary. Well, amid supply disruptions and spiking oil prices from the ongoing conflict in the Middle East, the International Energy Agency has proposed the largest release of oil reserves in its history. This according to the Wall Street Journal. A release which would surpass the release of 182 million barrels following Russia's full-scale invasion of Ukraine in 2022 is set to be decided on today, after G7 energy ministers stopped short of an agreement on Tuesday. Sources had told CNBC on Monday that the US believed a joint release of 300 million to 400 million barrels would represent, by the way, 25 to 30% of the 1.2 billion barrels held in reserves would be appropriate. Well, Dan joins us more now. Dan, amidst all the confusion, the opacity and the fog, give us some clarity, my friend.
Well, Steve, I think this ultimately shows just how sensitive this market is to any development around the Strait of Hormuz. And after we saw oil prices hitting triple digits earlier this week, obviously that volatility has a direct impact on the price. So traders here following the money and also following the news flow, working out exactly what could potentially happen next here. On the IEA as well, G7 energy ministers, of course, met this week to discuss a possible release of oil reserves. As you've just said, they stopped short of making a decision so far, but all eyes are on what they could also do next. The United States believes a joint release of between 300 and 400 million barrels would be appropriate. That's according to CNBC sources. And as you say, it would represent about 25 to 30% of the 1.2 billion barrels held in reserve by the IEA member states. It would also blow past the 180 million barrels released during the peak of the Ukraine war crisis in 2022. Pardon me. But what we're also seeing is analysts saying that the math here is looking pretty brutal. Analysts at Rapidan, for example, saying the closure of the strait has triggered what they're calling the biggest oil supply disruption in history. And unlike previous shocks that we've seen, there's really limited spare capacity as well to compensate, because all of the spare capacity, or most of the spare capacity, is in this part of the world. You can see it on your map right now on the screen. Saudi Arabia and the UAE themselves are cut off from the global markets. It's also something that the Aramco CEO Ahmed Nasser also referred to yesterday during that earnings call, where he actually said that this was the greatest crisis facing the oil and gas industry today. And of course, we saw oil prices surging above $100 a barrel at their highs on Monday before pulling back on expectations of a reserve release. Exactly what happens next is a big unknown at this point. All eyes are on the IEA to see what type of volume we might actually see coming out here. But of course, the impact that this may have is also being very closely watched as well, because it may take time to actually translate into the system how soon the oil can hit the market, what type of oil could hit the market, and exactly where that oil is going to come from and where it's going to go are all still unknown at this point. It's back over to you.
Very good, my friend. Thank you very much indeed for that. Quick look at where gas prices are trading. This isn't just about oil. This is about LNG. It's about gas as well. And we're having a look at the Dutch TTF. Well, I can tell you the European TTF was down 19% yesterday. That is the lowest level since March 2nd. But year to date, you can see that enormous spike in energy prices for Europe, up 62.5%. Massimo Di Eduardo is head of gas and LNG analysis at Wood Mackenzie. Massimo, thank you very much indeed for joining us. We spent a lot of time looking at crude, at Brent, at WTI. We should spend as much time looking at gas and LNG, I presume you would believe. Tell me a little bit about the shock that the global buyers have had from the shut-in from Qatar and other places.
Well, obviously, the LNG flows that comes through the Strait of Hormuz, it's about 80 million tons of LNG. And that, to give a sense of the proportion, is about 20% of global LNG supply. And so clearly the market is very unsettled at the moment. We're seeing prices, shooting up to 100% in terms of where they were pre-crisis. As you said, now they've come down a bit. They're now trading about 50 to 60% above where they were pre-crisis, with actually Asian prices trading, quite above that level. And that's really a dynamic that results in Asian buyers, which are the major destination of LNG from the Middle East, really having to scramble to get additional cargoes that were now going into Europe, but they're trying to direct those back into Asia. And this is really creating a big premium at the moment in terms of LNG prices in Asia.
Massimo, I don't know if this is a silly question or not, but I'm going to ask it nonetheless. Who suffers the most from this? I hear on one hand it's the Europeans, because of course their reliance on Middle Eastern product, or it's the Asian economies as well. Who is really where is the part of the world that suffers the most on the back of this?
Well, certainly, again, Asia is the one that is more reliant on the commodity itself, right? Whether that's LNG or oil, and so those are the ones that will see shortfall in terms of actual imports. And again, for LNG, 90% of the volumes from Qatar and the UAE goes into Asia. But in terms of overall prices, that's the additional spot prices they'll need to pay for the additional cargoes. All the other, LNG imports will continue to be priced certainly higher because they're linked to oil, and so oil is also higher, but nowhere near, the spot prices that they're paying. On the other side, Europe might have a slightly lower prices at the moment in terms of LNG and gas prices, but the whole system is going to pay that very price, right? Because all the system itself is priced at that spot prices, and despite actually having very little imports from Qatar and the UAE, they'll pay a very big price in terms of system. So
Massimo,
Europe,
yeah.
very, very exposed for sure, despite
Massimo,
not importing much Qatari volumes.
to get into the weeds on the Asian spot premiums, why can the Asians simply outbid Europe? Is it a functionality of the market structure there? Is it something about the ability to pay more because of the commerce that is done there? What is the backdrop to it?
Well, it's really the only option that they have, right? So on one side, you're going to see, countries that have, little ability to pay these very high prices to do emergency measures to reduce demand. We've seen an announcement from India, Pakistan, and Bangladesh. And so, a way for them to absorb the shock is effectively to reduce demand. On the other side, you see other players and other markets that have the ability to play and will be looking to substitute those cargoes that are missing from Qatar, that are going to go there into the market, again, try to outbid European players, and eventually try to get a lot of the LNG that is really flexible from the US that was going into Europe, back into Asia. Now, the trick part of it is that because a lot of ships from Qatar are stranded at the moment because they can't go to the Strait of Hormuz, the shipping market as well has shot up extremely, really high, right? So prices were in the range of $30,000 per day, to get an LNG carrier ship. Now they've gone up well above $200,000 per day. So to actually divert that ship that is going into the Atlantic to the Pacific is becoming extremely expensive. And that's why at the moment, Asian LNG prices trade, $4 to $5 above European prices. That's not to say that they'll be able to divert all of the LNG, right? I mean, there's going to be a tussle between European buyers that on their side, have relatively low level of storage, and so they've got a need to put more gas into storage to avoid, big surprise in the winters, particularly under these conditions of crisis. But certainly, big buyers, including Japan, South Korea, Taiwan, and to some extent China, will be there into the market trying to compete for those marginal
Massimo,
cargoes.
no doubt you were having the same conversations that we were having on the back of the last energy shock in 2022. And one of the economists we speak to a lot on this channel, Daniel Lakai, has been somewhat critical of the ability of the Europeans to regroup and come up with a sound strategy to avoid the next crisis, the one we're facing today. As you look at the landscape around LNG, other energy in the mix, do you think that Europe has been too slow to ensure that it could avoid a crisis like this?
Well, I mean, obviously, Europe could have done more, right? But to put things into perspective, European gas demand, following the Russian-Ukraine crisis has reduced by 20%. That's substantial, right? I mean, obviously, part of that has been at the expenses of the industrial sector because of the high prices, but part of that has also been about conservation of energy in terms of, the residential sector, but also in terms of, investing more into renewables, into Europe, into the power sector. Could the European do more? Certainly, right? More long-term contracts certainly increase security of supply. Strategic gas storage is something that certainly Europeans should think more. But, no doubt, this additional crisis will put minds to think about what else Europe could do and what else other markets could do to avoid, future shocks.
Massimo, I'm just interested to know the sort of the practicalities of this. I mean, let's say, who knows how long the conflict will go on for, but let's say at the end of this week, things look like they're de-escalating. How quickly can supplies of LNG start to return to normal, given the complexities of the process involved in cooling it and transporting it, and how it's far more concentrated in fewer facilities than oil, for example?
Yeah, no, that's a great point, right? And that's part of the reason why, gas has shot up so much and more than oil, right? To your point, all of the risk is concentrated into one big facility, which is the Qatar facility, obviously. And the Qataris have put out a few statements, alluding to the fact that, They don't know whether there has been damage. I mean, satellite images suggest that there is no real damage on the infrastructure. But obviously, when you shut down a field like the ones that the Qatar has done, which is the biggest gas field in the world, eventually, to bring it back, issues could happen, and so the operation needs to be very carefully done, and at the same time to eventually, start liquefying the gas in such a big complex with a number of different trains. Eventually, the liquefaction itself and the bringing back trains is going to be sequential. So they cannot do everything at once, but they need to do those sequentially. So this means that eventually, the earliest that that LNG could go back to full capacity, we're talking perhaps something in the range of 4 to 5 weeks. So if there was going to be a ceasefire very soon, you still see disruption of flows for a number of weeks, and it's only perhaps again 4 to 5 weeks that you could see flows going back to some sort of normality. So it's a substantial amount of time.
Within the last half decade, this is the second price shock in energy prices and gas prices we've seen, the previous one being after Russia's full-scale invasion of Ukraine. What sort of lessons are there in terms of future resilience and for countries and companies to try and insulate themselves, if anything, that they can do in future?
Well, I mean, diversification, needs to be part of the solution, right? This is certainly not good PR for gas, right? As you say, following the Russian invasion of Ukraine and now this crisis, governments will be looking quite a lot harder in terms of how their supply mix looks like, and certainly. They've been thinking about investing more in renewables. And, if they look at the geopolitics of coal, it has a lot less risk. But at the same time, let's not remember that gas, continues to be an extremely flexible source of supply, particularly to support the flexibility of renewables, and obviously it obviously has a lot of less, CO2 emission and particular emissions compared to coal, right? So it's going to be hard for those companies to move away from gas, and obviously, it takes decades to rethink a supply mix. So, there's certainly going to be a soul searching in terms of how supply mix are, in terms of different countries. But again, it's a very long process. Another element that certainly, lessons that governments should think about is considering strategic gas storage, similar to what the oil does, as a way to try and mitigate the increased volatility that the market is. In terms of the companies, again, volatility is going to be, diversification is going to be the mantra, right? You'll see companies that are very exposed to the Middle East, looking for a more balanced, perhaps, portfolio. And the US is an obvious option, but obviously the US also comes with some political risks. And there's not going to be a lot of options there, right? I mean, the projects that are there at the moment that are, up and running are obviously places in the Pacific, including in Indonesia and Papua New Guinea. Sure. And Argentina is coming up as a possible options. Canada looks extremely positive at the moment, given.
Massimo, we must leave it there. I appreciate it's a big question to have asked you, but we are out of time. Massimo D'Edoardo, head of gas and LNG analysis at Wood Mackenzie. Thank you for your thoughts and analysis. Now, still to come on the show, Renault shares flatline after the automaker unveiled its future-ready strategy. We'll bring you Charlotte's conversation with the CEO. Plus, as the data centre boom stokes energy demand concerns, we'll be live in Dublin looking at one potential solution. And we'll dive into the outlook for private markets with the chair of Hamilton Lane. That conversation coming up right after the break.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
JP Morgan has reportedly hit the brakes on lending to private credit groups, marking down the value of certain loans in their portfolios, which serve as the collateral these firms use to borrow from the bank. That's according to the Financial Times, which says the loans that have been devalued are the ones to software companies amid this year's AI jitters. Our next guest says AI is now the dominant driver of returns across public and private markets, and that recent private market underperformance is mainly driven by public market concentration on the Mag 7, not by weakness in private assets. Hartley Rogers joins us now, Chair of Private Equity Group, Hamilton Lane. Thank you so much for joining us. It makes sense. You look at some of the big demands in the marketplace for raising of debt, and the likes of Oracle was one of the first, but others have joined the party over at Alphabet and beyond. Just talk to us about almost a bifurcation that you're seeing in credit markets now, thanks to the story of the deep needs for AI.
Well, I think that the private credit markets are very, very large. Certainly funding the AI build out is a really interesting part of the market, and it's one of the parts that we like a lot because it falls under the general category of infrastructure, and infrastructure investing, infrastructure lending has been a real growth area with a lot of good potential promise there. So when you look at what private markets firms are doing, which tends to be below the level of the sort of Mag 7 and what they are doing in terms of building out data centers, building out things that access into and out of the data centers, that's been a really critical trend and an enormous spend in the US and around the world.
Let's just get into the sentiment a bit around some of those big spending requirements from the hyperscalers, because the message they've been sending, they're cash cows, very big growth companies for many years. Now we think about a different profile for them, that they're tapping the markets. Some of their loans, I think one was for 100 years, which is not something we'd seen for a long time, since Motorola back in the day. Yeah. So in that situation, is the market going to have digestion issues for some time to come because they just have to get used to these demands? Or is there something in the weeds that people are concerned about at some point? How are we thinking about that sentiment?
I mean, I would separate the hyperscalers, which are very big companies, principally investment grade, going out into the public bond markets, from the real private credit markets, which are funding more the private equity, the smaller companies, the more growthy type stories that lie underneath them. So I think the hyperscaler numbers, they're sort of able to get what they can get depending how the market is. That's almost more similar to the treasury bond market or the gilt market or whatever, rather than looking purely at the private credit market.
Hartley, lovely to meet you. You've said so many things I want to contest, if I may, so let me try and be relatively robust but polite, which is rare for me. If I say to you the words unlit dark fibre, it's enough to send shudders through your industry, I think. Yes, maybe not you, but you talked about the infrastructure side of things, and that seems totally logical. Don't invest in spurious models, invest in the real capacity. I get that. But when I hear the words unlit dark fibre, and it was actually one of the top gentlemen in European tech who mentioned those words to me, he's talking about 25 years ago when we had the last stunning investment boom, and a lot of that infrastructure was never used. Yeah. What do you think?
I think more of it's used than you would think today. I just think it took a long time to catch up. There was definitely a timing issue, and I think that's a great point, because with AI, nobody knows what the actual rate of adoption is going to be, and nobody knows exactly how this is going to play out in terms of developing the applications that are going to work. So we certainly see a lot of bright spots. It looks to us, if you look at the adoption rate, and we're publishing our annual market overview today, which we're happy about. It's a big deal within Hamilton Lane. And one of the things that we talk about is what's going on in AI relative to, say, the .com time versus the SaaS time, when things from sort of 2010 through the 2010s, 2020, how that was adopted. If you look at the growth rate of AI and revenues from AI, it looks much more like the SaaS adoption than the .com. The .com just kind of never went anywhere. It kind of exploded. It took a long time then for people to figure out how to build models that worked on the internet. A little bit less true with the AI.
Because I remember full well the noughties. I remember the 3G auctions when I was at the Press Association, before I'd even joined Dow, before I joined CNBC. And the operators were arguing with the government, who were operating with the infrastructure providers and the handset makers and the software providers. They were all blaming each other for the slow adoption. But I take your point. You think it's more like SaaS rather than that as well.
Yes.
But you talked about the rate of adoption. And now I'm a big fan of, I'm very terrified about what AI is going to do, but I think it's going to be pervasive and diffuse. and what have you. My problem is not rate of adoption, but rate of route to profitability, to ROI, ROC, ROTE. That is where I have questions, because this isn't just about a couple of big American players. This is where global companies, including the Chinese, including some of those small startups, are really coming up with the goods.
No, I agree. I mean, I think you have to separate the LLM layer, which is very hard to forecast where that's going to go. You have companies like an OpenAI against the Gemini, where Gemini obviously is part of Google that has huge cash flows and can support. OpenAI has had to go out and raise money, the largest ever venture capital fundraise last week, to be able to stay the course and with that. So the question of how OpenAI will make money eventually relative to a competition from someone like a Google is pretty significant. If you look at an Anthropic, that's slightly different because they're focused on a different part of the ecosystem. And so if you talk about people who are doing their own coding and things like that, vibe coding, using Anthropic, there's a lot of that. It's very high potential, and people are getting amazing results out of doing that. So I think the potential profitability in that sort of application layer is really real and interesting. And in our own business, we see it every day.
Yeah, that was a fascinating answer.
Hartley, if people were investing in private credit and they're looking at the funds and they're saying, well, look, when would I get a return on this investment in hyperscalers and big data centers? And then they see the energy price shock and they think, gosh, the cost of running these, the operating costs have just soared before there's even a return in visible on the horizon. What's your assessment of that?
I mean, that's a really good question. I think that comes down to a geopolitical question of how long this is going to last right now. I think if you're looking at oil prices north of $100 a barrel, up 120, 130, lasting for a long time, that is going to have broad ramifications across the economy around the world, in Europe, in Asia, in the US, no matter what, and it's going to impact everything, including the cost of electricity that is going to fund these things. So I think the question of how long this goes on is the material question. Right now, the markets seem to be thinking it's not going to go on that long because the markets have been pretty resilient so far. I think they're looking at the history of the last year in terms of various initiatives that President Trump has done and thinking, well, he's really got to find his way out of this fairly soon. If it doesn't happen and prices stay high, then I think you could have some real issues.